Coming up on Market to Market, China throws a counterpunch in the latest scuffle over tariffs. A Midwest producers partnership with an East Coast dairy giant. And market analysis with Tom Fitzenmeyer next.
We've got a lot of...
Wherever your operation takes you, or who you share it with, we'll be where we've been all along. With you from the word go. Proud sponsor of Market to Market.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today. And by Sukup Manufacturing Company, offering a full line of grain drying and storage equipment and steel buildings. Sukup Manufacturing is on a mission to protect and preserve your crop and the tools that produce it. This is the Friday, August 10 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Delaney Howell. U.S. trade disputes continue to squeeze rural America. The price of doing business is always on the rise, but trade tariffs do little to cushion the blow. The Consumer Price Index rose 0.2% last month. When increasing food prices and decreasing energy prices are pulled out, core CPI added an equal amount. The pressure on American pocketbooks was reflected in the Purdue CME Ag Economy Barometer. The index fell sharply as declining commodity prices and an unknown outcome to trade disputes have taken a toll. Trade negotiators spent another week working with NAFTA partner Mexico. All parties are hoping to achieve an agreement before President Nieto steps down in December. Discussions with Canada remain on hold. The more volatile boxing match with China is building more steam. Those opposed to raising the stakes on both sides of the Pacific are making their voices heard as the search for a resolution continues. John Torpy reports.
Promises were kept this week in the escalating trade war between the world's two largest economies. Earlier this week, President Trump ratcheted up the pressure on China by putting tariffs on an additional $16 billion worth of imported goods. The first set of import duties was launched in early July, with a list of just over 800 items, which added $34 billion to the cost of new products. The Trump administration appears to be in the fight for the long haul, as officials are creating a list of tariffs that will add $200 billion to a large catalog of Chinese imports. In reaction, the Chinese Foreign Ministry announced retaliatory tariffs of $60 billion against U.S. imports, including farm commodities and industrial chemicals. Chinese officials labeled President Trump's recent move as one motivated by a mobster mentality, and they claim the tariffs leveled by the U.S. could harm the global economy. The trade war has been fueled by President Trump's accusation that China used unfair business tactics to secure trade secrets from U.S. companies. The new import taxes are expected to go into effect later this month. All of this back and forth has farmers and ranchers worried about lost markets that will be difficult to reclaim. The Trump administration has set aside a one-time assistance fund of $12 billion to help farmers impacted financially by the escalating trade war. The American Farm Bureau Federation is happy the Trump administration is looking out for farmers, but believes the aid package cannot and will not make up for the long-term damage to agricultural exports. For Market to Market, I'm John Torpy.
Dairy producers are fighting a battle for survival. Overproduction and export declines are piling up on top of rising production costs that outpace revenues. There are federal programs to help make ends meet, but a few producers have chosen a different path. Peter Tubbs has more in our cover story.
"1,200 Holsteins receive their morning milking at McCarty Farms in Rexford, Kansas. Their milk is high in volume and butterfat compared to other Holsteins in the dairy industry, and the path their milk will take to the customer is unusual.
We desired a greater connection to the consumer, a greater connection to the people who bought our milk, and a greater valorization of what we felt were our best practices, in the hopes that in doing that, it would create a better economic model.
The evolution of the model originally began when the McCarty family moved in 2000 from Pennsylvania to western Kansas in search of lower feed costs. Yet a decade of low dairy prices kept profits at the family business thin. The pursuit of a different business model led the McCartys to Dannon, the largest yogurt maker in the United States. The McCartys were looking to stabilize a volatile bottom line. Dannon was seeking price stability for its products and had specific needs for its raw milk.
We envision a food system that is a little different than it is today, in the sense that we want to be working with Mother Nature and with the dairy farmers to change how food is made, because that's what shoppers are increasingly looking for.
Changing consumer preferences are driving food producers to design supply chains that allow traceability of their products right down to the farm. Several companies, Dannon among them, have found consumers that are interested in traceability are willing to pay a premium for the privilege.
And more recently, we've just introduced our first non-GMO Project Verified yogurts, which are verified to the feed of the cows.
80% of the dairy's forage is purchased from the region. The 8,200 milking cows that McCarty Farms milk at operations in Kansas and Nebraska have been on an entirely non-GMO feed regimen since June of 2017. The process of creating a non-GMO feed supply took 18 months and required the McCartys to convince local farmers to change their seed preferences. For the McCartys, the increased costs and record keeping were worth the extra work.
Very warm reception with those farmer partners, and obviously we had to harvest the forages, which takes some time, and then we had to build the entire system of traceability and protocols and whatnot to comply with the standard.
The partnership between Dannon and the McCartys is more than just vendor-client. The bulk milk price the two sides negotiate is based on an open books philosophy. The McCartys open their books and share their costs of production with Dannon in order to earn what both believe to be a fair price. Profitability for both buyer and seller is maintained. Each side believes this open policy is better for both sides of the equation.
Over time, Americans have been looking differently at the foods that they're eating and wanting to know more about where they come from, how they're produced. And no surprise, interest in non-GMO options is growing. And so we, through direct relationships with farms, are now able to provide a non-GMO Project Verified option in non-organic yogurt that previously was not available. And the only reason we're able to do that is because of the direct relationships we have with dairy farmers and the ability to work with them over a longer term period so that they can plan accordingly for their feed inputs to ensure that they too are non-GMO Project Verified.
The relationship between Dannon and McCarty Farms also carries environmental and animal welfare expectations. Border areas of the farms are now planted in native grasses to reduce mowing and encourage wildlife. Chemical use on forage ground is limited. Crop rotations are required. The dairy cows have access to feed and shade and are closely monitored for signs of health issues or a change in milk output. The focus on animal welfare has led McCarty Farms to become the first dairy in the nation to earn all 4 Validus certifications, a third-party verification of socially responsible on-farm production practices. Dannon has committed to sourcing milk exclusively from Validus certified dairies.
Animal welfare is something we as a company are very passionate about, the health and well-being of dairy cows. It's also something that consumers are increasingly interested in. And so we believe Validus is the gold standard in the United States. And it's a process that we're so committed to that we put it into the agreements with our dairy suppliers. And it's part of the cost equation that we are also bearing because it's that important to us.
Milk production from McCarty Farms' 4 dairies is trucked to the Rexford, Kansas facility to be condensed before shipment to Dannon Plant number 48 in Dallas, Texas. By evaporating 75% of the water in the bulk milk, Dannon reduces the carbon footprint of its yogurt. The reclaimed water is filtered and reused on the farm for drinking water for the cows, cleaning of the plant, and irrigation of crops. In an arid climate that receives only 15 inches of rain per year, 50,000 gallons of water reclaimed each day represents a large percentage of the dairy's water use. In the short term, the financial details of the changes Dannon and McCarty Farms have made in their supply chain raise the price of doing business. However, in the long term, being accountable to the customer will be the profitable position in a commodity business.
The real goal is, how do I do something that's positive and bigger than me, bigger than us? And I think this model gives you the springboard to doing some things like that.
From Market to Market, I'm Peter Tubbs.
Next, the Market to Market report.
The WASDE provided an end-of-the-week bombshell that obscured earlier reports of tighter European and South American production. For the week, September wheat lost a dime, while the nearby corn contract fell 12 cents. The August WASDE cut the legs from under the soy complex in the final session as the September contract plummeted 41 cents. September meal dropped $8.90 per ton. December cotton shrank $2.89 per hundredweight. Over in the dairy parlor, September Class 3 milk futures bounced 42 cents higher. The livestock sector was mixed as the October cattle contract lost $2.75. September feeders shed $3.50 and the October lean hog contract put on 40 cents. In the currency markets, the U.S. dollar index skyrocketed 126 ticks. Crude oil dropped 85 cents per barrel. COMEX gold fell $4.20 per ounce. And the Goldman Sachs Commodity Index lost more than 3 points to settle at 458.50. Joining us now to offer insight on these and other trends is one of our regular market analysts, Tom Fitzenmeyer. Tom, welcome back.
Thanks, Delaney.
Tom, we certainly have a lot to talk about this week with the WASDE report coming out here Friday. Let's start with the wheat markets. The USDA lowered EU crop, but didn't lower world production supply overall. Why?
I'm not sure why. I think that's yet to come. We dropped pretty hard on Friday, but I would guess it'll bounce back for the very reasons you're talking about. They didn't do that, but I don't think there's anybody in the trade that doesn't believe they're going to have to eventually. If you take between the European and the Black Sea region and the mess they've got in Australia, eventually I think one of the concerns is that it hasn't translated to
into
big
prices.
export
Right.
sales
Well, that too, yeah.
for the U.S. And I think there's an expectation that eventually that's going to happen. Although the other problem with wheat, when you start getting a couple bucks above corn, you start losing some of that feed demand, start switching back to corn, which is a benefit to the feed side on corn, but it's sort of a limiting factor in the wheat market. Again, we had a good break Friday. I'm guessing we'll stabilize probably early next week.
Okay. Were you surprised by USDA raising Russian wheat crop?
Yeah, I think everybody was. That's all we've been hearing about is the problems they were having over there. So, yeah, there were several things in the report that I think were a bit confusing and had people kind of sitting up in their chairs about 11:05 on Friday morning.
Absolutely. I want to ask a quick social media question before we move on to talk about corn WASDE report. We've got Neil Harris. He sent in a great question on Facebook. With lower wheat production and bad weather around the world, will wheat lead all markets higher? And if it does, how long will the markets rally? I think that's really important here.
It already has led. It is the leader. Like I said, we're a couple bucks above corn. Having said all that, I think your upside potential probably isn't much higher than the high sixes in wheat, if that. So, you start getting those kind of wheat prices up there, I think you need to be pretty aggressively marketing. Because like I said, our export sales haven't really followed along. So we kind of need that component to get going before we can go a lot higher, I think.
Absolutely. All right, I want to transition here to corn. The USDA came in much higher than the average trade guess with yield, and they also did change ending stocks, but they weren't that much higher than the average trade guess. Why was that?
Why wasn't the carry-out much different?
Yes.
Well, they did bump the demand a little bit, so that was part of it. I don't know. I thought it came in a fair. I thought the production number was quite a bit higher than the USDA came up with, but like I said, they offset it with demand numbers. They increased their export estimate. I think they increased the ethanol usage, increased feed usage. Like I said, I think that came from the wheat switching back to the corn. So, yeah, I mean, we're talking new crop because the old crop, they didn't change anything in that. So, yeah, I think we're up, the carryout was increased like 132, 136 million bushels, something like that, the net of the production minus the demand adjustments.
With that higher yield number, I think it was 178.4 or somewhere right in there.
Correct.
That's the highest number on record for the U.S. Are you concerned that we're going to have too much? I mean, they said, ending stocks. Are you concerned we're not going to be able to chew through that amount of corn or higher production?
Well, here's the dilemma. Say they're a little off on their demand. Maybe demand's a little better than they said, and that carryout's 1.6 instead of 1.684 or whatever they came up with. The problem that I see is going forward, because with corn prices relative to where beans are, I think the U.S. farmer's going to plant the daylights out of corn next year at the expense of wheat acres. And so 1.6 carryout is tighter than we're used to. It's 400 million less than we had last year. But if we have that kind of an increase in acreage, I don't know, we could be right back up to having a lot of problems chewing through corn. Now, demand for corn's been good. We have the cheapest feed grain actually in the world, even including wheat. So I think the demand's going to be quite good for it. Ethanol demand's quite strong. But it's going to be hard to work our way through that, and some of that's already been anticipated. I mean, the increase in demand. So I don't know. I think corn prices are going to struggle. You get December corn up toward $4, and that's probably about it. And you better, if you get a good pop up into December of 19 corn, and you're one of those that are planning on increasing their corn acres next year, you better start getting some of that sold. Okay.
Since you opened the door for acreage discussion, you said switching over from wheat acres to corn. Do you think some of those soybean acres are going to transition to corn, wheat, cotton, some of those specialty crops because of all the trade stuff? And the WASDE report was fairly bullish, or bearish, excuse me, for the soybean market.
Yeah, I mean, why would you produce beans when corn prices are so strong relative to bean prices? The other problem for the bean market is that with Brazilian bean prices running, what, $1.80 to $2 above the U.S., the Brazilian producers are incentivized like crazy to plant beans next year. And you have to assume that the Argentina crop is probably going to go back to more normal, and they're not going to have the mess that they had this past year. So you got a bunch of beans getting dumped on the world market again, with the Chinese demand going to South America and away from us. Hopefully that'll get worked out, but it doesn't look like that's going to happen anytime soon.
Absolutely. I want to ask you one more quick corn question before we move on to soybeans. Going back to the yield a little bit here from the USDA, is this yield going to come down because of the fast pace of corn maturity that we're seeing this year?
That's the theory. That's what all the bulls tell. That's what the farmers tell me, that there's no way we can have a good crop when it's maturing this fast. Well, maybe, maybe not. I don't know. That's the slow maturity is kind of what some people think surprised us on the upside on yield last year. And so the theory is that since it's faster this year, the yield, we're not capable of having decent yields. And I'm not sure I've totally buy into that yet. You know, we've got the several crop tours coming up over the next 3 weeks. I think maybe that'll tell us a little more than, I mean, the USDA data was taken a week ago, so it's almost a little bit on the old side.
Okay, maybe old news. Let's transition here to the soybeans. They had a big day on Friday, losing 41 cents. Pretty bearish report. Ending stocks, more than 205 million bushels increase. Why did we see such a large increase in those numbers?
Yield. They bumped yield. And they had, if you sit and think about it, if they gathered that data last week, what the heck were they going to look at in a bean field last week that would tell them anything about yield? Nothing. So the only basically thing they had to go by was the crop condition rating, and the crop condition rating substantially above a year ago. So you almost had to bump the yield in line with that crop condition rating versus a year ago. So that's where it all came. They made some minor little adjustments to crush and exports, but basically it was that big jump in the yield. And that pumped, I mean, 785 million bushel carry out for next year. That's a heck of a lot of beans.
Why didn't they increase the demand more than 35 million bushels?
Well, I don't think they know what it's going to be. I mean, how do you? The China thing gets worked out. That's a different scenario. We've had pretty good demand from other than China buyers, but has that just been bargain hunting? Has that just been, because we're cheap and they're front end loading, trying to get some bargains locked in, and later on that's going to sort of diminish? So there's a lot of unknowns on the demand side, and I think they just said, well, we're just going to bump it a little bit and see what happens in the next 30 days for the next report.
So with all of that being said, we had a large sell-off on Friday. Do you think we're going to stabilize at these prices, or do we have further downside risk?
Oh, no, we've got further downside risk. I think you'll go back and retest that July low on November beans around 8.26, something like that. I think they could even overdo it and nudge it down toward $8 before it's totally washed out. So, there's this pretty strong tendency when you have this negative a reaction to an August report for that to carry through fairly well into the following week. So, if they whack it hard for a couple, 3 days and next week, then I'd probably lose my enthusiasm for being so bearish, the bean market. And the weather hasn't really been what you'd call ideal for soybean production. There's a lot of areas that are lacking in rainfall, and I guess then we'll have to see if we can start to maybe rebuild a little bit.
Absolutely.
Here.
Tom, really quick, your quick thoughts. If, with that being said, what strategies should producers be looking at in the bean markets?
Oh, I think, again, you get November beans up in that $9 to $9.25 range. If we could possibly do that, then I think you have to be a seller of new crop. Most farmers are done with old crop sowing. There's not a lot of that around. The problem is going to be basis. I think the basis has just been terrible, and I'm having trouble believing that that's going to. And I know the theory is as prices go down, basis tightens up, and historically that's kind of the way it works. I guess I'm not sure that's the way it's going to work this year.
Okay, live cattle cash prices. Where are we headed from here?
I think you're going to get bounces, but I think you're going to struggle with that. It's difficult to compete against pork as cheap as it is.
Absolutely.
Poultry as cheap as it is. And I know the economy's good. People have got a little money rattling around in their pockets, and that's part of the reason the demand has held up as well as it has with beef. But we've got more numbers coming at us, and I think you get back up toward this past week's highs, and you probably need to be a seller of cattle again.
Okay. What are your quick thoughts here on the feeders? Have we put in a summer high for our August feeders?
I don't know if that's necessarily true. That market tends to be driven quite a bit by feed costs, and feed costs are obviously down quite a bit with corn as cheap as it is. So I think those are going to hold on up fairly well. And again, I think the beef fat price is probably going to hang in there for. I don't see it falling apart, but I just would sell rallies, I guess.
Okay. I'm going to squeeze in one more quick social media question here because we don't often get them for hogs. Evan wants to know, are hogs near the bottom due to their extreme discount to the cash, or will we see lower prices moving into the fourth quarter?
I'd like to think they're near the bottom. You get those December hogs down in the low 40s, and it's hard to believe there's a lot of downside from that level. Now, the upside may not be much above 50 to 52. But I have no interest in being bearish on hogs down in those lower 40s. And I'm not saying some washout or some terrible thing couldn't happen that maybe go a little lower than that, but I wouldn't want to chase that, and you certainly could see a nice bounce back in that market.
Is now a good time to be looking at some strategies if you are a hog producer?
I think to look at them, I wouldn't implement anything until you get up above 50 on the December contract for the fourth quarter.
Okay. Tom Fitzenmeyer, we're going to wrap up this discussion. We're going to continue that discussion with cotton and other commodity questions in Market Plus, so thank you so much for your time.
Sounds good. Thanks, Blaney.
That wraps up the broadcast portion of Market to Market, but we will keep the conversation going on Market Plus, where we'll answer more of your questions. You can find it on our website at iptv.org/MTOM. Harvest will soon be upon us. Send us your harvest prep photos to post on our Facebook page. You can check out the entire photo collection by searching IPTV Market. Join us again next week when we look at how processors are bumping up shackle space to handle more hogs. So until then, thanks for watching. I'm Delaney Howell. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content.
Wherever your operation takes you, or who you share it with, we'll be where we've been all along. With you from the word go. Proud sponsor of Market to Market.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today. And by Sukup Manufacturing Company, offering a full line of grain drying and storage equipment and steel buildings. Sukup Manufacturing is on a mission to protect and preserve your crop and the tools that produce it.